Welcome to the deep dive. You know, if you've been watching the global markets recently, you've probably seen this crazy contradiction.
Oh, yeah.
Well, yeah. I mean, on one hand, the news, it's all panic, right? Headlines screaming about record volatility, geopolitical risk, all that stuff.
Standard market fear, you mean?
Exactly.
Yeah.
But then if you kind of look under the hood, the actual financial structure, it seems to be signaling this deep, almost quiet confidence. It just doesn't add up.
High fear, high stability. It seems impossible.
Right. It's a total paradox.
It is impossible, or at least it seems that way, unless you've got a method, a way to filter out all that emotional noise.
And that's what we're digging into today.
Precisely. We're looking at a proprietary analytical framework today. It's called Structural Intelligence, developed by Devin McClarty over at D Investment Enterprise.
Ah, McClarty's work.
Okay. Yeah. This whole deep dive really is about decoding what they've built. They use these specific metrics designed purely to measure structural integrity, kind of ignoring the market's day-to-day emotional roller coaster.
Okay, so we're talking about tools like the Dinar Divergence Index, the DDI.
That's the main one, yes. The DDI and its cousin, the Confidence Correlation Index, or CCI.
Gotcha. So our mission today, for you listening, is really to unpack this toolkit. This is the system that let McClarty's team look at the market data back on November 1st, 2025, and actually declare confidently a state of monetary equilibrium.
Right, amidst all that surface panic.
Exactly. This is about getting that knowledge fast, but getting it right. Sort of a shortcut to understanding how these financial ecosystems are, well, how they're designed to almost think for themselves.
That phrase, ecosystems that think for themselves, that's basically the definition of structural intelligence. You know, McClarty's whole philosophy rests on a simple idea. Structure outlasts speculation.
Okay, structure beats guessing. Makes sense.
Well, yeah, every analyst knows sentiment goes up and down, it's volatile, but it's the underlying structure, it's discipline that really dictates whether things hold together long term. And to measure that discipline, you need the right lens.
And that lens, according to this framework from D Investment Enterprise, is this tripartite idea, the one that sums up three huge global assets.
That's the one. It's simple but powerful. Gold measures fear. The dinar measures faith. The dollar measures dependence.
Okay, let's break that down. Gold measures fear. That feels pretty intuitive.
It's the classic. When the world gets anxious, where does money flee? Usually to gold. So gold's role is pretty clear. It's the main gauge for fear. You know, worries about inflation, political chaos, that flight to safety instinct.
Like a fever thermometer for the market.
Exactly. A high reading means high anxiety.
Okay, gold is the thermometer. Then you bring in the Kuwaiti dinar, the KWD, and that measures faith. Now, honestly, that might surprise some listeners. Why the dinar? Why not say the euro or the yen as the benchmark for faith?
That's a really good question, and it actually highlights why the framework works. The dinar, the KWD, it's chosen because it's not a major global reserve currency.
Okay, how does that help?
Well, it means it's less tangled up in the big geopolitical games that swing the euro or the yen around. More importantly, the KWD has shown, well, remarkable stability, strong fiscal discipline.
And that's backed by?
Massive, steady oil revenues. And they manage it conservatively. So it has this high structural credibility. It represents confidence in a system that just works. It doesn't inflate wildly or devalue based on every little external pressure. It's the steady hand.
The reliable benchmark against which you measure discipline. Okay.
Right.
So gold is fear, the thermometer. The dinar is faith, the steady regulator. What about the U.S. dollar? The framework says it measures dependence.
Yeah, the dollar's role is unique. Its value isn't just about its price. It's tied to how deeply it's woven into everything, the global financial plumbing, essentially.
Right. SWIFT, oil trades, reserves.
All of it. So the dollar measures the world's reliance on that whole structure. Even if everyone's scared, high gold, and other systems might look shaky, the world still needs the dollar system to function day to day. That reliance, that's dependence.
Okay, I think I've got the architecture. Gold for fear, dinar for faith, dollar for dependence. Now let's get to the tools, the actual mechanics. First up is the Dinar Divergence Index, the DDIO. You called it a structural mirror for the dollar.
Yeah, that's the term McClarty's team uses. It's not about catching every little price fluctuation. It's designed to filter for integrity, not just noise.
How does it work? What's the mechanism?
It's pretty elegant, actually. It tracks how much the U.S. dollar diverges from its long-term equilibrium point relative to the stable Kuwaiti dinar.
Long-term equilibrium. so it smooths things out.
Exactly. It focuses on the long-term relationship, deliberately filtering out the daily market chatter, the speculative ups and downs that usually buffet currency prices. It's looking for sustained systemic drift. Is the ship singly going off course?
Okay, walk us through how to read it then. This seems crucial for their model. What does a warning sign look like on a DDI?
A positive DDI reading, that's your structural warning light. It means the dollar is weakening, eroding against that disciplined benchmark.
Meaning it takes more dollars to get 1 DR than it sort of should.
Correct, based on that long-term equilibrium. A positive reading signals structural drift, maybe underlying inflation picking up, or just a gradual loss of confidence in the dollar's management, structurally.
So ideally, we'd want to see a negative reading.
That's right. A negative DDI reading confirms strength. It shows structural confidence. The dollar is holding its own or even gaining a bit relative to the dinar standard.
Okay.
Think of it like the health of an engine. A negative DDI means the engine is running efficiently, sticking close to its disciplined baseline. No worrying noises.
Right. So the DDI gives us that core structural health check on the dollar. But as you said, it doesn't tell us the mood, right? The engine might be fine, but the driver could be panicking. Gold tells us that.
Exactly. You might miss the bigger picture if you only look at the DDI. Which brings us to the second key metric in McClarty's toolkit, the Confidence Correlation Index, the CCI. This is what gives you that more holistic view, the economy's mood.
Because the DDI and gold might point in opposite directions.
Often they do, and that's exactly what we saw in that November 2025 data we mentioned. The CCI helps make sense of that. It combines the DDI with Brent crude oil prices and gold prices.
Okay, 3 inputs.
Right. And by putting them together, analysts can figure out the quality of market confidence. Is it based on real discipline, real faith in the structure, or is it just, a temporary sigh of relief because fear dipped for a moment?
Let's just quickly nail down the roles within the CCI. We know gold is the emotional hedge. What about the others?
Okay, so Brent crude oil, its symbolic role is the fiscal backbone.
Because it props up the KWD.
Exactly. Its price stability is key to ensuring the KWD benchmark stays credible. It reflects that solid commodity wealth and liquidity that stabilizes the whole structural equation.
Got it. Backbone. And the DDI.
That's the structural mirror, like we said. It reflects whether the dollar is maintaining its discipline or drifting away from it.
So the CCI blends the mirror, the backbone, and the hedge.
To give you a single, more nuanced judgment. Is the market feeling good because things are genuinely solid, or just because panic eased off temporarily?
Right. Which brings us perfectly to applying this. The moment where this framework supposedly cracked that big paradox of late 2025. You had fear everywhere, yet de-investment enterprise declared stability. Let's use their framework on the actual November 1, 2025 data.
Yeah, this case study really shows off the filtering power we've been talking about. So let's start with the loudest signal, the most emotional one. Clue 1, the gold price. On that date, it was $4,016 an ounce.
Wow. Okay, that's historically very high. That screams fear, no question.
Unambiguously, global anxiety is definitely elevated at that point. You just look at that number and you think, panic.
And normally you'd expect that level of fear, that $4,000 gold, to start seriously undermining the dollar's structure, wouldn't you? People hoarding cash, capital flight.
That's the conventional wisdom, yes. But McClarty's framework, this structural intelligence idea, it pushes back on that. The paradox exists specifically to show the difference between, let's call it, emotional memory and actual structure.
Okay. Explain that.
Well, yes, the memory of past crises, the general anxiety, pushed gold way up to $4,016. But there were 2 other clues in the data that day that painted a very different structural picture.
All right, clue number 2.
The steady oil price. Brent crude was locked in around $64.77 per barrel. Pretty stable.
Okay, $64.77. Why is that so important?
That's the bedrock, the fiscal backbone we talked about. That steady oil price is crucial because it signals a reliable, sufficient revenue stream, keeping the KWD benchmark credible.
So the faith measure is holding strong because its foundation is solid.
Precisely. If oil prices were all over the place, the KWD itself would be unstable and the DDI wouldn't mean much. But because that backbone is solid, the KWD's role as the anchor of faith is secure.
Okay, fear is high, gold, but faith is stable, oil at KWD. Now the linchpin, the clue that resolved the paradox. Clue 3, the neutral DDI. The reading was -0.34%.
Almost zero.
Right. But hang on, how can the dollar's fundamental structure be stable, showing a near zero DDI when global panic has pushed gold over $4,000. Doesn't that level of fear have to infect the structure somehow?
See, the framework argues, not necessarily, not yet anyway, that tiny negative reading, net of 0.34%, it's a neutral structural signal. It confirms the dollar's core integrity is holding firm against its disciplined benchmark, the KWD.
So people are panicking, running to gold.
Yes, individuals are hedging with gold out of fear, driven by that emotional memory. But the fundamental plumbing, the deep systemic relationship between the dollar and its anchor, isn't breaking down. The currency isn't collapsing or inflating wildly.
The system's core is stable, even if its users are freaking out.
That's the idea.
Okay, so let's put it together. Clue 1, high fear gold. Clue 2, stable faith foundation, oil KWD. Clue 3, stable core structure,
Yeah.
neutral DDI. And when you combine those,
You get the conclusion McClurdy's team reached: monetary equilibrium.
monetary equilibrium.
It's a really powerful concept. It's not saying everything is calm or peaceful. It's a state of balance. It happens when that high external fear, shown by gold, is effectively counterbalanced by a deep, quiet confidence in the underlying system structure, shown by the neutral DDI and steady oil.
The system is stressed,
Yeah.
clearly, but it's not breaking.
Exactly. The core integrity is holding because that fiscal discipline, that structure, is still functioning.
So the big insight isn't that the market's fine, it's that the structure is resilient despite the stress.
That's it. And the really profound takeaway here is what they stated. When fear and faith balance, dependence becomes visible. Meaning the loud noise of gold, fear, and the quiet discipline of the Dinar Divergence faith essentially cancel each other out in terms of predicting immediate collapse. What's left? What becomes clear? The dollar's true role, the world's fundamental dependence on its structure, its plumbing, that structural trust holds even when emotions are running high.
Wow. Okay, so for you listening, if you're trying to cut through all the market noise, that's why these tools matter. You stop just reacting to headlines and start reading the actual blueprints of the system.
Right. The structural health that DDI measures lets you, well, kind of sidestep the daily emotional whiplash. You're looking at underlying integrity, not just surface price swings.
And the CCI gives you that needed context.
Yeah, it provides the nuance, balancing the fear drivers like gold against those discipline markers, the DDI and oil. And crucially, it shows that high fear and deep structural confidence can coexist. They're not always mutually exclusive. That defines the equilibrium state.
Let's pivot then, look forward. If this structural intelligence philosophy, this toolkit from D Investment Enterprise, really holds water, it ought to have predictive uses, right?
Yeah.
What happens if that DDI starts to drift steadily positive over time?
Well, that's where it gets really interesting as a potential early warning signal. A sustained positive DDI in drift, because it filters out the short-term noise, would strongly suggest a genuine structural shift away from discipline.
Signaling what, potentially?
It could be an early flag for deep-seated inflation starting to take hold, or maybe a brewing systemic liquidity crisis. It might pick it up long before conventional metrics, which often lag or just react to that emotional memory we talked about.
Interesting. The source material, McClarty's work, also mentioned applying this beyond just the US dollar system, thinking about smaller nations.
Ah, yes, the Dinar mirror model. That's the idea. If you have smaller countries battling really volatile currencies, instead of trying to peg to another major currency that might be volatile itself or politically influenced.
They could use the KWD model.
Exactly. They could sort of mirror their fiscal management against a disciplined, structurally sound benchmark like the KWD. It forces internal fiscal responsibility, monetary discipline, aiming for stability that gets recognized externally. It's using structure to fight volatility.
A structural solution, not just a currency peg. And the final frontier mentioned, digital assets, blockchain.
Right. I mean, the core principle of the DDI is measuring integrity against a stable, disciplined benchmark. Does that need apply only to fiat currency?
Probably not.
Probably not. So there's huge potential, theoretically, to adapt DDI principles to assess the structural integrity of, say, major digital assets or even whole DeFi ecosystems. Are they built on solid ground or just hype?
A standardized, non-speculative way to measure discipline in a space that's often, well, let's just say excitable.
Precisely. Is this asset just popular this week, or is it actually structurally sound for the long haul?
So wrapping up this deep dive, what we've unpacked here gives you, the listener, a way to stop just reacting to the market's emotional swings, its memories. It lets you start seeing those deeper currents, the structural trust, the discipline that actually drive the financial engine. That feels like a real shortcut to being properly informed.
It absolutely does. And maybe it leaves you with a final thought to chew on after we finish. When you look at the market news tomorrow, you see prices jumping, falling, whatever, just ask yourself,
Yeah.
how much of that movement reflects the true structural integrity these tools are trying to measure versus how much is just emotional memory, the market reacting to the ghost of yesterday's crisis or last week's fear.
The DDI helps you tell the difference.
It aims to.
Yeah.
As Devin McClurdy's team put it in their De-Investment Enterprise report, and it's captured in that quote from the Financial Engine, markets don't move by magic, they move by memory. The Dinar Divergence Index is that memory in motion.